Welcome back to America's Commercial Real Estate Show. I'm Michael Bull. The segment is brought to you by RedIQ.com. Check it out. It magically takes static PDFs and Excel spreadsheets and puts it right into the software. It saves a ton of time for underwriting multifamily. It's called RedIQ.com. Well, today we're talking about commercial real estate financing and apartment financing. You know, it seems like the way financing goes can certainly impact the cycle and the market. Please welcome my next guest. It's Adam Finkel. He's a principal and co-founder with Tower Capital, and he's joining us on the phone. Adam, thanks for being with us.
Hi, Michael. Thanks for having me with you today. I appreciate it.
Thank you. And Adam helps borrowers and property owners secure financing for all types of properties all around the U.S. He's headquartered in Phoenix, Arizona. And, you know, the first thing I think that my listeners and viewers are curious about, Adam, is what are you seeing for rates? It seems like rates have kind of been up and then down and sideways. What do you see rates now, and how are they trending?
Sure. You know, we've been expecting interest rates to rise for quite some time now. It looked last year like they were finally going to. And then, you know, now they're down about 100 basis points where they were, you know, fourth quarter of 2018. So the borrowers have certainly gotten some relief. You know, many of the loans that we do are going to be based upon, you know, the 10-year Treasury is a major index for commercial real estate loans. And, you know, that was below 2% about a week or two ago, and now it's up about 10 basis points. So it seems to be bouncing right along that, you know, 2%, 2.1% yield area. We're anticipating rates to stay low for the foreseeable future, and unless there's some kind of shock to the system. I know that, you know, there's been a lot of pressure on the Feds to start even lowering rates again. I'm not sure that that's necessary at this point in time. So right now we're in a very low interest rate environment, and I anticipate it to stay that way for at least the near term.
Yeah, well, I guess that's good news in the commercial real estate world. Well, Adam, what do you see for underwriting today? You know, it seems like some people we talk to are concerned about the length of this cycle. What has it been, 10 years? It's been a great run, and some people are thinking, well, surely the good times have to end sometime soon. But, you know, all the indicators seem very positive. So what are you seeing for underwriting? Are any of your lenders starting to be a little more stringent?
You know, I'm seeing underwriting standards being maintained. I'm not necessarily seeing them tighten up at this point in time. I think really throughout this cycle, unlike last cycle, the lenders have really maintained pretty stringent underwriting standards. You know, they're not going overboard on leverage. They're making sure that a minimum debt service coverage ratio is maintained. So that's leading to a very healthy finance market right now. You know, certainly in some markets, you know, there can be some hesitation about supply coming on board. You know, especially when you start to see, you know, multifamily in certain markets, you know, there's been a lot of new development. You know, I think everyone's very cognizant of where we are in the cycle right now. It seems to be long in the tooth, yet the underlying metrics are very healthy. So, you know, again, I mean, the lenders are, you know, still being pretty strict with their underwriting in today's environment.
Well, I guess it's good if they're somewhat conservative. Keep us all in line, right, Adam? But what about some of the sources? Are any of the sources, Freddie, Fannie, banks, are any of them showing any reluctance on any certain sectors? You mentioned multifamily, but you know, heck, multifamily and industrial have been so hot, and of course there's pockets you have to watch for of overbuilding and bad markets anywhere. But when you look at overall, are there any lenders or banks that are kind of pushing away from certain property types right now?
I think as you alluded to, multifamily industrial have really remained the darlings of the market. Retail, there still seems to be a lot of heartburn and hesitation with retail. I think we've seen that over, really since the downturn. We've seen retail properties being repositioned. I think it really comes down to the market and where the property is located and the strength of the sponsorship. But I would say if there is one sector that people are still wary of, retail would be that.
Yeah, and I went to your website, your Tower Capital website, and I saw that, look, you've done some development loans and some land loans. So what are you seeing there?
Yeah, well, certainly there's a lot of appetite for development. Where we are in the cycle right now, you're seeing a lot of new developments coming online. With a strong sponsor and a strong property and a strong location, there's a lot of available financing. If any one of those things are off, it can be very challenging. So, what we are seeing out there is both with, conventional lenders along with the alternative lenders that have become more prevalent in the marketplace today. Everyone has a lot of money that they're looking to try to place. And so, there is still that caution of, what happened last time around. So, that's why we're seeing underwriting being maintained. But, if you can check off all the boxes, strong deal, strong sponsor, strong location, the financing is very, very competitive today.
And Adam, the alternative financing that you alluded to there, is some of that financing that can't be done with the bank or Freddie or Fannie or a live company, is that kind of second choice financing that maybe has a bit more risk? Or are you seeing some of this alternative financing really be competitive with the major lenders?
Sure. Well, the alternative lenders certainly have their place. Typically we're seeing the alternative lenders are debt funds or opportunistic funds that typically have a shorter time horizon than the traditional lenders. So, they want to be in and out of a deal in, 2, 3, 4 years, get their yield, and then recycle that money. And so, typically on the shorter term bridge loans for transitional properties, the debt funds, the alternative lenders, they're a good source of financing for that. We've really seen the spreads reduced greatly in that space because of all of the competition. So, we're seeing on average, bridge deals, call it for a transitional multifamily property, pricing from, LIBOR plus, mid 200s to, LIBOR plus, mid 5s, mid 6s, depending on the risk threshold for the property. Another product that we're seeing being offered by the alternative lenders is what we call these stretch senior loans, where it's allowing, investors and developers to obtain higher leverage than, the traditional lender. So we're seeing loan to cost being pushed up, 80, 85, 90% in some cases, where the lender is actually holding an internal A note and B note, and they're offering the borrower a blended cost of capital for that. And so that's becoming very, very prevalent as, people are really trying to, push their leverage. We work with a lot of developers who are syndicating, and, obviously the higher the leverage, the more of the profits that they can keep in their pocket. So,
I like it. So 85 to 95% in some cases, and of course that's non-recourse, right, Adam?
Correct, non-recourse,
Really?
Interest only.
It is. Nice. And we haven't seen, we're brokered to Southeast, and we do a lot of different property types here. And I've not seen any issues, seems like, for a long time with appraisals coming in low or have any problems with them. Are you seeing that anywhere? Are there any changes going on with the appraisal process with the banks or anything? Any tips or things we should watch out for?
When it comes to appraisals, typically on an acquisition, the appraiser is usually going to find a way to get there if, the numbers are realistic and the deal makes sense, even if someone's pushing value, because you have a willing buyer and a willing seller. And so, where we see more challenges is on the refinances when someone's trying to do a cash out refinance, say, they bought the property a few years ago, they renovated it, they got the NOI up, and now they're trying to pull some cash out, recoup their capital, and then reinvest that into other deals. And so, quite often when we have folks that are really, pushing for dollars, they're pushing for LTV, they can stretch too much, and then that's where you can get into trouble sometimes. But, I'll be honest, in a market like Phoenix, when, some of these multifamily properties were trading for, $20,000, $30,000 a unit, 5 or 6 years ago. Now they're going for $100,000 a door, $80,000, $90,000 a door. People are saying, well, how can that be? How are they getting the financing? Well, the thing is, people have renovated the properties, the rents are up, we're in a stronger market, there's higher NOI, so, higher loan dollars and higher values can be supported. So, sometimes it can be somewhat psychological when someone's been in a market for a long time and they've seen prices and now they're wondering, this isn't making sense. But, when you really dig into the numbers, we're in a pretty strong market right now, and that's, helping to push the values along with, obviously low interest rates and cap rates remaining pretty low as well.
Yeah, that makes good sense. And Adam, if you could, before you leave us, what tips would you give borrowers today to maybe make the process easier to get a loan or faster to get a loan? Some of these properties have multiple competing bids, and the sellers come back and want things to be done very quickly. Any tips for borrowers in that regard?
I would say just really having all of your ducks in a row, perhaps having a letter written by, your lender or, whoever you're working with, your finance professional. What we see as far as once you get involved in the transaction, typically the deal is only going to go as fast as the borrower can provide the information. So if the borrower is providing information expeditiously, the loan will go, much quicker and much smoother.
Do you ever go ahead and order your third-party reports in advance on day one, or is that you really need to wait and see who the lender is?
You always want to wait for who the lender is, because the lenders are going to have their pre-approved lists of vendors, and they're also going to have their specific requirements, for the vendors. So sometimes if someone, goes out and they get an appraisal early, that appraisal may not be able to be used. So you typically want to wait for, the lender to order their own third-party reports.
And how much time are you seeing from start to finish typically to get these loans closed today?
With a traditional bank lender, credit union, or for apartments, Fannie or Freddie, it's typically going to be a 45 to 60-day process from once you get the lender engaged. You sign a loan application, you send them their deposit, then the clock starts ticking. Some of the debt funds, opportunistic funds that we were talking about earlier, they can close in 30 days. Some of them can close, even shorter, but, obviously those are going to be the higher interest loans. You're paying for that speed.
Right, absolutely. Yeah, we provided some money for someone the other day that wanted to close in 3 days. Of course, that's expensive money, but if the deal's right, it can certainly make a lot of sense. Well, Adam, thanks for joining us, sir. We appreciate you being on the show.
Great. Thank you, Michael. Appreciate it.
All right, and thank you for joining us. Well, stay with us. We're going to have more on commercial real estate financing. Stay with us. I'm Michael Bull. This is America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bull Realty. For customized asset and occupancy solutions, visit bullrealty.com. Commercial Agent Success Strategies. incredible training for commercial agents. Visit commercialagentsuccess.com.